All right, thank you, Sam, and thanks everyone for joining us today for the 2023 year-end tax webinar. As Sam said, my name is Tony Cavoli. I am a principal in our tax consulting group and will be helping to moderate today. And joining me is Lisa Pohl, who is our Director of State and Local Tax, as well as Paul Meany, who is a leader in our credits and incentive practice. So if we can move on to the agenda, and before we get started with that, when I was putting my notes together for this year's webinar, as I kind of do to start out every year, I was looking back through the past 12 months or so and trying to remember exactly what happened that made 2023 stand out. So essentially, so I could come up with our topics and our theme for this year's webinar. And I was having some difficulty doing so. And it sort of dawned on me that the reason 2023 seems so what we call kind of ordinary or uneventful is that really the past 5 or 6 years have seen so much change when it comes to the tax world as well as obviously to the real world too. So if you think about it, we go back to 2017, we had major tax changes with the Tax Cuts and Jobs Act at the very end of 2017. So that brought us things like the 21% corporate rate, the 20% pass-through deduction for your partnerships and your S corps. We saw 100% bonus depreciation coming at that time. There was, estate tax changes, international tax changes. Really, the list goes on and on of what happened in 2017. So, that hit at the very end. And then 2018, 2019, we really had 2 full years of a lot of rules and a lot of regulations kind of coming out to implement those changes. And that guidance is still coming out today. So to this day, so 6 years after that law was passed, which really shows you kind of how significant those changes were in 2017. So if we're kind of following along the timeline here, that brings us up to around 2020. And of course, 2020, everyone knows that's when COVID hits. We saw several rounds of COVID related legislation, and that brought us items like, of course, the PPP loans, stimulus checks, employee retention credit, which we'll talk about, and really a bunch of other non-tax related items and just concerns in general, like most people in this presentation, which is basically managing your business during those years as well. And that brings us all the way through 2021. We had several more rounds of COVID related legislation during that time. And now we're into 2022, which then brought us, worrying about things like high interest rates, high inflation. And towards the end of 2022, we kind of come to the Inflation Reduction Act, which was passed and which Paul will talk about some provisions in there. And it basically it drastically kind of expanded the green energy incentives in the tax world as well. So from 2017 all the way to 2022, we saw a lot of changes, which brings us into 2023. And that brings me back to kind of sitting in my office and trying to think of topics and a theme for today. And really, the theme would be sort of the past tax laws kind of creeping up on us that we've been able to kind of put off for several years because of everything else that was going on, but we do now have to address. So if we look at the agenda here, most of the items we're going to cover are the result of past tax legislation. So when I give the federal tax update next, it's mainly going to focus on issues that were a result of 2017 Tax Cuts and Jobs Act and the related or the COVID legislation that came out over the past couple of years. Lisa in her state and local tax update will be talking about some newer topics there. But then Paul's section, credits and incentives, will be covering things like R&D capitalization. That's the result of a tax law change back in 2017 that we now have to deal with. He'll be talking about energy credits, which is a result of the 2022 IRA that we are now getting a lot of guidance on. And then if we look at that last section there on the Corporate Transparency Act, this was a law passed back in 2021, so during COVID, that is now coming into effect into 2024. So a lot of issues created in the past that we now have to address over this year, 2024, and going into 25 and 26 as well. So let's move on to our federal tax update. And we're going to start out with a recap of the Inflation Reduction Act. So this was the law that was signed back in August of 2022. So over a year, over the year it's been passed into law at this point. And what it was really a pared down version of Democrats' tax reform. So what was included from the tax side, because there was a lot of non-tax related items in the IRA, but from the tax side, that's where we saw this 15% corporate minimum book tax that was basically on something called adjusted financial statement income. Now, the thing here is that this only applies to corporations over $1 billion in income. So we're talking about, the largest 1% of corporations in the world. If we skip down to the fourth bullet point, there's a substantial increase in the IRA to IRS funding. So an additional $80 billion were set aside for the IRS. Now, since then, some of that 80 billion has been clawed back as a result of negotiations between Democrats and Republicans on certain spending bills. But the one thing that's clear, for the IRS, at least for now, they are going to have a lot more resources, and there's been a lot of focus, especially in the media, on what they're calling the tax gap, what the IRS has been calling the tax gap, basically due to wealthy individuals not complying with tax laws. And it's definitely debatable whether or not that tax gap exists, but there is clearly going to be an increase in enforcement efforts by the IRS over the next few years. We know that the IRS is looking to hire a significant amount of new IRS agents. So we definitely expect the amount of audits to increase. The IRS has already come out and stated that they intend to significantly increase the amount of audits specifically on partnerships. So, just keep in mind that, if this funding stays in place, the IRS and the way that they operate are probably going to undergo some substantial transformations over the next few years as a result of this legislation passed back in 2022. All right, and then the last bullet on that slide we're going to skip over. Paul is going to be covering the energy credits in his section. So let's discuss some of the more recent federal tax changes. And to sort of continue with our theme that I mentioned, almost everything we're going to discuss in the next few slides are the result of legislation passed well before 2023 that we now do have to address. So if we look at that first bullet point on there, so companies that are subject to interest expense limitations, and this was the limitation that came into law as part of the 2017 tax law changes. So as of 22, so as of the last tax year, you are no longer able to add back depreciation and amortization when you are determining your interest deduction limitation. So what that basically means is that companies that either have significant debt already, or companies who are planning on taking on significant debt, who may have in the past were probably not subject to any interest expense deduction limitations. Now your interest expense deduction may be capped or limited in some way as a result of this change that, again, was part of the 2017 tax law changes. So just keep that in mind when you are kind of modeling out your cost of debt, that the interest expense associated with it may not be deductible on that income tax return. The second bullet point on their R&D capitalization requirement, as I mentioned before, Paul will be covering this one in his section. And the last bullet point on their restaurant meals will revert back to only being 50% deductible. So during COVID, as a way to really encourage people to visit restaurants, one of the smaller laws that was passed during that time made restaurant meals fully deductible for 2 years. That rule has now expired. Okay, so on the next slide, bonus depreciation. So bonus depreciation will continue to phase out over the next several years. So again, this 100% bonus depreciation was the result of 2017 Tax Cuts and Jobs Act. So just one thing to consider, to the extent that you can get something placed in service by year end, you will be able to take advantage of an 80% bonus depreciation write-off. If you can't get it in before 2023, that bonus depreciation amount is going to go down to 60% in 24. And then every year going forward, we're going to continue to see a 20% reduction until it's completely phased out by 2027. And this is, of course, assuming that there is no congressional action to bring back 100% bonus depreciation, which they are currently negotiating and talking about right now. So we have some other expiring provisions that aren't expiring in 24, but still are very important, even though they're several years off. And those are many of the individual tax provisions that were included back in that 2017 tax law. So I'm not going to go into details on each one there, but basically without any congressional action over, in the next 2 years, we're going to see things like higher tax rates for individuals. We're going to see the loss of the 20% pass-through deduction. Gift and estate tax exemptions are going to go back down to their pre-2017 levels. And there's several other items on there as well. So these things are still several years down the road, and there is always the chance that Congress will jump in and extend some of these provisions. Again, they're talking about several of these provisions right now to extend them at this point. So that's something we'll just have to wait and see, but just keep in mind that in a couple of years, if they cannot get anything passed, these changes are going to be automatic. They are going to revert back to the pre-2017 rules. Okay, so the next slide, we're going to shift gears a little bit and talk about the employee retention credit. So this is a topic I'm sure most people, if not all people on this presentation, have at least heard of, and a topic that we have actually covered, I believe, over the past 3 years, in the past 3 year-end webinars. So again, keeping with that theme that I talked about of sort of addressing past issues. Now, if you would have listened to the past 3 years of webinars for our year-end planning, we would have focused when we're talking about the employee retention credit on how the credit worked, what a great opportunity the credit could be, and technically still could be if you are eligible and you have not claimed it. But this year, our focus is really on significant developments that happened in 2023 with the credit. And that is the IRS's concern of mass fraud taking place in the program, and then the IRS's response to those concerns. So up until probably mid-2023, the IRS had only been issuing warnings advising taxpayers to basically kind of be wary of these aggressive third-party promoters who are out there, who are advertising businesses to basically claim the credit when they really are not, in fact, qualified to do so, and charging, of course, very high contingent fees along with that. So a few months back, the IRS announced that they were basically temporarily putting a stop to processing all new ERC claims, the keyword there being new, through the end of the year to really help combat these aggressive promoters. Now, a couple things to note is that the IRS didn't end the employee retention credit. They don't have that type of authority to do something like that. So, if you are eligible or you haven't looked at eligibility yet, you should still definitely do so. And you should still definitely file the amended payroll tax return. But I would say expect even more delays than before the IRS issued this notice. Now, if you did file prior to the IRS issuing this moratorium, because I said this is only applicable to new ERC claims, this should, again, not apply to those credits. But I would say with that being said, the IRS before issuing this was already taking, I'd say on average, 6 to 8 months to process amended returns anyways. And this only slowed down that process just based on our experience. So even though they technically haven't halted processing prior ERC claims, the time frame seems to be going up in terms of the turnaround for them to actually process it and issue the refund check. So if we move over to the right hand of that slide, in addition to the IRS kind of pausing processing, they also announced a method for taxpayers to withdraw specific ERC claims if you suspect that you weren't eligible for the credit in the first place. And again, this is a response to the IRS beliefs that these aggressive promoters out there have basically misled taxpayers into believing they're qualified and put the taxpayers in a very bad situation. So to be eligible for this withdrawal process, there's very specific requirements. And the big one on there, number one, is that the refund check must not have been received or cashed. So if you've already gotten the credit check, cashed it in your bank account, you won't be eligible for this program. But if you haven't, and you use what you'd say was an aggressive third party to prepare your calculations, and now you're sort of second guessing whether or not you were eligible, I'd suggest you would reach out to your Raymond advisor and put some thought into considering withdrawing that claim under this procedure. And just want to mention on that last bullet point, the IRS is working on guidance for companies that have already received the refund and cashed that check, but they want to essentially give the money back because of those concerns we've mentioned above. So more details on that will be or should be available over the next few months. All right, so we're going to move away from the federal side, and I'm going to turn it over to Lisa for a state and local tax update. So Lisa.
Thanks, Tony. You mentioned that we had some new items to cover, or newer areas or new changes for state and local. And I feel like on the state and local side, it's, the states just keep stretching what things that we've been used to. And the first change is for Michigan, a change on how for sales tax, they're taxing delivery and installation charges. So this change came about on April 26th. Prior to April 26th, almost always delivery and installation charges were subject to sales and use tax, even if they were separately stated on the invoice. After April 26th, if the items are separately stated and you have books and records that show how the tax was levied, they are not subject to tax. Now that varies by state, how that's going to be taxed and whether or not they're included in your sales and use tax base. It's a big change for Michigan. The reason the state made the change is it was often a point of contention, a point on audit, often it led to lawsuits. People might be aware of this. It seemed to have gotten some attention, but the reason we're bringing it up is, if we can go to the next slide, is what do you need to think about as someone who's in Michigan, or if you're dealing with customers in Michigan. If you are selling, you know what to do with your invoice. But what we've often found when working with clients is they're not thinking about the things that they're purchasing. So as a customer, hopefully you've got someone that's in accounts payable that is taking a look at the invoices and saying, is the delivery and installation charges separately broken out? And if they are, have they been excluded from sales and use tax? Because once you pay that invoice, your only recourse is to go back to the seller and ask them for a refund. And that seller, it's at their discretion. They can either agree and give you a refund, and they can go back to the state and ask for a refund for the amounts that they've refunded to you, or they can decline to. As long as they've remitted any tax that they've collected to the state of Michigan, they are not obligated to issue a refund to you. So that it takes some due diligence on the buyer's side to make sure that they're getting the advantage of this change. So we just want to make sure that the practicality of how to apply that is that people are aware of that. Because oftentimes you might be working with people who are unaware of the change. You might be working with companies who are in the state of Michigan who don't know that change happened. And it could be an opportunity that you're missing out on. Another area where we've seen a lot of changes, if we can go to the next slide, think I just covered that. If we can go to income franchise. Sorry about that. On the income franchise side of it, changes that we're seeing with Nexus. And I'm going to cover this at a high level because Nexus is a somewhat complicated concept, or can be a complicated concept. Nexus is just enough of a connection with the state that they can subject you to their tax rules. And there is a federal law that protects you, businesses, from having to comply with income tax rules. It's Public Law 86-272. And that law says if all a company is doing is soliciting sales of tangible personal property, and that tangible personal property is going to be shipped from another state to that state, that company is not subject to income tax. Well, recently, the Multi-State Tax Commission came out with new guidance saying that certain internet activity exceeds the protection offered by Public Law 86-272. So if you have a website and you offer these things on your website, you no longer get this protection. So if you offer online job applications, if you offer upgrades to your product, if you offer certain types of manuals, warranty sales, certain internet cookies, if you offer those, they're saying that protection's gone. You're now subject to income tax. And if we can go to the next slide. So that change was a couple years ago, but the states are now gravitating towards that. Because if you think about it, they're saying, well, now we've got a whole new group of taxpayers that we can subject to income tax. So what we're seeing is California has regulations where they're saying, yes, we are going to follow that. New York has draft regulations. Minnesota has proposed legislation. New Jersey has some regulations that they have adopted. Many other states are just indicating that they're going to follow it. Some states might just apply it without making a pronouncement that they're going to follow it. And they are saying, we agree. We agree that by having this type of internet activity, you've lost this protection. California is already being challenged in court on this position. And the challenge is really, or the challenges that I've seen or what people have been talking about is really, how is this any different than maybe what was offered before? How does the internet really change anything? You know, if you have a chat feature that's offered online, how's that any different than when people had access to a telephone? Public Law 86-272 was passed, you know, many years ago. And at that time, if people had a question, if they bought a product, they'd pick up the phone. How is having a chat feature any different? Internet didn't change anything. If people had to upgrade a product, perhaps you sent them an electronic link through email. Internet didn't change anything. So those challenges are saying this has not changed anything. We didn't need new guidance. The new guidance is faulty because nothing's really changed. So in the meantime, as a company, what do? Do you follow the guidance? Do you wait to find out what the states are doing? Once again, or I say once again, because the state and local tax is the world they live in, we're often left with saying it depends, and it's a gray area. If you're in a state like California where they seem to be pretty aggressive, it's probably best to see what your liability is and keep watch of it, and watch as the other states come on board. It means that even though you might not have changed where you're doing business and how you do business, you likely have to keep watching to see what the states are doing. For businesses that are pass-through entities in Michigan, it could be a planning opportunity. It's likely a planning opportunity where you could state that you have Nexus in one of those states and avoid throwing back sales to Michigan, thereby reducing your apportionment in Michigan and lowering your overall tax in Michigan. Because states like California and New Jersey are certainly going to assert that you have Nexus if you have one of those listed activities that say they exceed the protection of Public Law 86-272. So again, this is a reminder of the practicality of, even though you might not have changed anything, you're gonna have to keep up with what the states are doing and how they're trying to expand their tax base. And if we can go to the next slide. So our next slide is on sales tax. So the sales tax, we're all hopefully used to the concept of what came out with Wayfair. And Wayfair was the case that said, based on volume and a number of transactions, the state can subject you to sales tax. And every state now that imposes a sales tax has an economic nexus standard, which just means you don't have to have anyone physically in the state to be subject to their sales tax rules. It's important to note that, once again, even though you might not have changed what you're doing or how you're doing it, the states are changing what their standards are for the economic nexus standards. So the trend has been to eliminate the transaction threshold. And the trend has also been to change the definition of what a sale is, where some of the states are now saying they're not including exempt sales. So states where you might have had nexus, you may no longer have nexus if everything that you sell is wholesale, or is to someone who can claim a manufacturing exemption. So they continue, the states continue to refine their definition of what qualifies as a sale and what their economic nexus standards are. Also to point out that on the flip side of it, states are expanding what they subject to sales. So commonly overlooked property and services that are taxable in many states are digital goods, downloaded apps, streaming videos and music, and remotely fixing and upgrading software. Michigan typically doesn't tax those items, nor do our surrounding states, but a lot of the southern states, especially states that do not have personal income taxes, tax all of those items. And also both of a lot of our coast states will tax those items, and it doesn't take much for those liabilities to really add up, which kind of leads into our next slide of business transactions and nexus considerations. I think that with at least for what we've seen a lot more business transactions under consideration in the last couple of years. I think perhaps they were on hold during COVID. And state and local always seems to be the hot area. Might be it's just a little overlooked. Nobody likes it. And so it kind of just gets overlooked a little bit. So it's kind of low-hanging fruit, and especially with all the changes. So a couple of things to keep in mind, even if you don't think the transactions in the future, things that will just help with, if you're the buyer, is to review all potential nexus for all tax types, even if they indicate that a nexus review was previously completed. As I mentioned a couple of times, things keep changing. So the MTC, where they're changing how Public Law 86-272 protection is being viewed, that change just came about in the last couple of years. So if the target said, well, we just had a nexus review in the last couple of years, that might not have been considered. Don't take their word for it and do a new one. And make sure you set up appropriate escrow balances to make sure that you're covered. And if you're the seller, make sure that that you're doing your own review to make sure that any amounts that they're trying to escrow, any amounts that the buyer is trying to escrow, that they're reasonable, and that you get a chance to maybe address any outstanding liabilities in a reasonable manner. There's a lot of opportunities that states will give you if you go to them before the state has approached you, where you might have a chance to really cut off some of that liability and help whittle away at some of that escrowed amount. And those were the updates that I had for state and local, and I can turn it over to Paul now for credits and incentives.
So thank you. So the next three topics for the credits and incentives, I'm going to primarily talk about the R&D tax credit, which some of you may already have some familiarity with. Also, Section 174, which is research and experimentation, which you might have heard of, and as Tony indicated earlier, as part of one of those budget reconciliations under the Tax Cuts and Jobs Act. And then the third will be energy credits. And I think, before we get into the details of it, I think what's important about these next three areas are, right, just making you aware of, right, what are some of those incentives that can become advantageous for your tax posture just based on identifying activities that you're doing on a daily basis within your company. And I think, whether that's, one's ability to pay less in taxes or reinvest in the company or identify other areas for the company to utilize some of these savings opportunities. I think, again, just making sure you're aware of the opportunities out there is really the goal of these next couple slides. So with that, I want to start with the R&D tax credit. So if we go to the next slide, really the intent was in the early 1980s to come up with a credit that incentivized highly paid engineering and manufacturing personnel in the United States. And so you typically hear the phrase, it's a dollar for dollar savings against the company's tax. So you could argue it's one of the more advantageous benefits within our tax code. And so really the primary code sections are Section 41, which is the R&D tax credit definition. But I think it's also important to mention that Section 41 is a more narrow subset of Section 174, which is important for the next section where I'll talk about research and experimentation, which has this new requirement starting in 2022. But the best way to think about the R&D tax credit is for federal purposes, for any credit identified, it's around 6 cents on the dollar. So a good example might be, let's just say somebody is an engineer and hypothetically they make $100,000. Most of their work is qualified work for the example purposes, right? We'll qualify them at 100%. That can be $6,000, just that one personal loan that you could utilize to offset some of your tax. And then that even, on top of federal, there are numerous states that also offer an R&D tax credit as well. And so between federal and state, you can actually start to see there's a lot of advantages and much more benefit than you may traditionally think of. So if we go to the next slide, want to just talk about what exactly are those expenditures we should be thinking about, right? So there's really 4 of them. The first is just wages. So again, it's a US-based tax credit. So we think of your W-2 box 1. The second would be supply costs. And really, we look to an unburned material cost. And so the test is really not necessarily where the supplies originated, but really where it's used or consumed. And again, that supports the notion of, right, it's a US-based tax credit. So even if we source it from a foreign country, if it's utilized, sample batch trials, first article production runs, right, those are examples of material costs that can qualify under supplies through those development efforts. The third would be contract research. So again, a lot of times we might utilize third parties or consultants for their expertise or to assist us in that development or design process. And so we can take third-party contractors. And again, it's not necessarily where they originate, but where they're actually performing the work. And so that becomes important because, again, as long as they're performing the work within the US, that is a contractor we can take. There are some additional requirements around contract type and funding. But again, I think the important thing is to note when you think about just thinking, is R&D relevant? Who might be included in the potential qualifying activities? Third-party contractors could be another example. And then really the fourth one, which I think we've started to see a lot more in the last decade, is what's called computer rental or lease costs. And so a lot of times, right, as technology and software becomes more integrated in almost any industry, you're starting to see that we can take things such as web hosting costs. So let's say we're a manufacturing client and we've created some automation for the process of one of our products, and we're utilizing Amazon Web Services or Azure, right, to help us with efficiency or scalability. Those web hosting costs might be examples of qualified expenditures that we can take. Obviously, within software industries or tech industries, we see a lot of migration now from servers to the cloud itself. And so data latency issues, things lag time, how efficient our inventory is being shown to clientele. Those are just examples where those cloud hosting costs can actually start to add up, and we can actually utilize them from an R&D tax credit perspective. That being said, R&D is highly scrutinized by the IRS. So I think what's really important when thinking about the R&D is, one, what is our qualified activity? What is the benefit based on the overall tax posture? But I think what I would want to emphasize the most is there's a documentation element to this. It's not necessary that we have to document to the dollar itself. A lot of times, right, we can use just an individual's firsthand testimonial knowledge to substantiate a lot of the positions. So when we think about what is the burden on us to calculate this credit, a lot of times, right, we may it doesn't have to be necessarily super sophisticated in the sense that we have to have time tracking. A lot of times most companies don't have that. So we might identify a couple subject matter experts that can speak to, individuals' activities or the personnel they're overseeing. And I think another great advantage to the R&D credit is sometimes it might not be utilized, whether in whole or in part in a particular year based on your taxable situation. So we have the ability to carry back 1 year or carry forward up to 20 years for federal. And a lot of states actually kind of mirror, not necessarily in the time frame of 20 years, but a lot of times you can carry it forward up to 15 years for a lot of states as well. So you get to see that benefit both from a federal and state perspective. Going to the next slide. When we say R&D, right, what do we really mean? So yes, it can be your traditional notion of it's a scientist or an engineer, and manufacturing industry, which is what, again, it was originally kind of legislated to kind of adhere to that industry. But we've seen that, the R&D credit now it's utilized in almost every type of industry, right? So if it's pharma or if it's software, it's tech, it's construction, right? It's environmental. So you name the industry, right? As long as we're undertaking a design or a methodology or capability where we're trying to make it better, cheaper, faster than before, right? There's a potential for qualified activity that could be beneficial and could, again, lead to a dollar for dollar savings against the company's tax. So when we think about breaking up what are those areas, right? It could be a product, right? So we could develop something. It could also be a process, right? So we may have already had an established product, but we've created new ways to be more efficient in how we actually get that product to market. So we've created automation. So let's say we have 5 steps and we've reduced it to 3 or 4 and created automation, utilized software. That in and of itself could be a qualifying activity that could be used as part of the R&D calculation. And then the benefit of itself, right? Again, we spoke to this just a little bit earlier, right? It can be used to reinvest in the company, to expand to new products or business components, right? It can help with your effective tax rate, cash flow. So again, there's a lot of options, and depending on the year, right? Sometimes it's utilized in whole, sometimes in part. You have the ability to carry it forward or even sometimes carry it back. So going to the next slide. When I say R&D, what are those qualifying criteria? And while yes, R&D is scrutinized by the IRS, the test is actually relatively broad in the sense that, again, it's to incentivize U.S. development, which is at the core of something that Congress's intent of, again, if we're making something better, cheaper, faster, there should be a tax benefit for it. And so it's called the 4-part test. And really it stems upon, is the product or the activity based on something that's technological in nature? So again, you're one of the principles of the hard science, engineering, physics, biology, computer science. The second criteria is qualified purpose. And really what it's saying is whether or not you're designing, developing, creating, modifying either a new or existing product or process to make it better, cheaper, faster than before. And again, I think the emphasis there is it's not always just a new product, right? Again, a lot of times, whether it's software or even just a tangible product, right? There could be multiple versions that we're always improving. Those are different areas where, again, it's not necessarily a new product, but because of those versions and the uncertainties we had to overcome, that would be an example where the version of a new product, or again, a process could qualify just as much as you creating a prototype. So what's required is always that we have some form of technical uncertainty. And this is when I mentioned what are the code sections that are relevant. That technical uncertainty is this 174 requirement, right? Where, at the beginning of the development of the new or existing product or process, there's some technical uncertainty regarding its capability, methodology, or design. And then that leads into the process of experimentation, which is really what I think demonstrates the broad nature of the tax credit. So it could be as granular as your traditional notions of R&D, systematic trial and error, root cause analysis. But also it could be, let's say we have individuals, project managers, where we're sitting on meetings and we're talking about the design, or what are the results of the testing, and do we need to make any changes or modifications, right? Those whiteboard brainstorming sessions, those are all examples of other individuals that can qualify as well. Even personnel in a liaison capacity where they maybe are getting market feedback and relaying that information. Those are other examples of where it's not just those traditional personnel of engineering and scientists in a lab creating something. Those direct support and direct supervisory personnel can also qualify. So when you think of that benefit, it can start to add up when you think about, even a project manager qualified at 50%, in the aggregate, as you start to add up those individuals, it can start to really kind of start to make a real impact or material impact to your tax return. So then going to the next slide. That leads us into this 174 research and experimentation. So as Tony mentioned a little bit earlier, under the Tax Cuts and Jobs Act, we initially had this great foundation of, okay, we got a reduced corporate tax rate. We got 20% off, for partnerships. But it was under a budget reconciliation. And so they had to figure out ways to pay for that. And one of them was 174, which was historically we could deduct those expenses, now requires us to capitalize and amortize those. So unfortunately, unlike R&D, which is an election, 174 is a compliance requirement. So as long as you have elements that where you are developing something, even without something that's technological in nature, we have to identify to capitalize and amortize those costs. And so I think the easiest way to think about it is for wages or employees, you essentially, if it's a US based personnel, you have to depreciate their wages over 5 years, 15 years if it's a foreign person, or if it's a foreign cost. And so additional requirements, you've maybe heard of things called incident to costs. Those would be in addition to your wage, your supply, your contract research. There could be things such as utility costs or rental costs that might need to be included as well. And so what you have is you have this interplay between R&D, which again is a direct dollar for dollar benefit against the company's tax posture, and this 174 component, which is more of a timing difference similar to depreciation, where we have to amortize those costs over 5 for US and 15 for foreign. Going to the next slide then. So where do we stand on this? It's first became relevant for 2022's tax year. However, under those proposed regulations, there's a lot of question marks, a lot of open, a lot of inquiries into, okay, what is the definition? What is it applicable to? So the IRS opened up for comments that closed on November 23rd to get additional guidance on, what really is that concrete definition. And so it's anticipated that they'll provide us with final regulations starting in Q1 or Q2 of 24. Now, I think everybody hopes that 174 gets repealed. But what I will say is, just because the IRS is receiving comments and then will provide final regulations on this, does not have any correlation to whether or not Congress will repeal this or not. They're acting separately. It's just Congress. The IRS now has to address some of the holes from the amended 174 definition. So with that being said, within the last year, there's been already 3 bills that have been introduced to repeal 174 to its historical definition. Whether or not that gets passed, again, it was under a budget reconciliation under the Tax Cuts and Jobs Act. So to repeal that, they're going to have to figure out, similar to bonus, right? How are they going to mitigate the anticipated revenue as a result of these legislative changes? The other thing that I think is important is, because we have 174 for federal and so many states also offer an R&D credit, you likely will then have this impact at a state level. However, what you're seeing is a lot of states are now trying to enact their own legislation where they may not follow it. So right now there's about 6 states, for example, California, Texas, Georgia, that actually don't follow federal for 174 purposes. So you could still get the R&D benefit without having to capitalize and amortize for state purposes. So it is important to just make sure we're keeping up to date on understanding, okay, even if it's still relevant for federal, is it applicable for state? Going to the next slide is really just an area of opportunity. So if we flip to the next slide, there's been a huge push for renewable energy, and under the Biden administration and the Inflation Reduction Act that Tony was mentioning earlier, there's a heavy investment into clean energy, environmental policies that can help. And so while a lot of our economy is still predicated on fossil fuels, there's obviously this now a large tax incentive in a variety of areas to help, whether it's taxpayers or the economy, as far as, what does clean energy look like? So if we, go to the next slide, there's a significant investment in making sure, okay, if we're going to undertake these new avenues for how we may develop something. So again, if it's even a manufacturing process, right, can we do it so that our carbon footprint is a little bit less? What on top of that could we incentivize taxpayers? And so, if we go to the next slide, there's a variety of different credits available, whether it's from environmentally friendly clean vehicle or solar powered vehicles, the charging stations themselves, to the solar panels themselves and the installation of those. One thing that I think is really interesting about that is it's not just providing a credit for installation or the use of an electrical vehicle, but also providing options for some of these new credits where you can actually transfer those credits to a third party if you don't need to utilize all of them. So if we go to the next slide, we just kind of list out a couple additional areas of credits that could be, in addition to just the vehicles and the solar panels, which I think you hear the most about, but other areas that could be relevant, again, when we think about reducing that carbon footprint and what are some of those incentives. I think the biggest one, though, is the investment tax credit. And that one's really geared towards utilizing solar panels, especially on buildings, right, to reduce energy costs. So if we go to the next slide, I think this is hopefully a high level visual for you to just understand what are some of those tax breaks we can get if we implemented or installed solar panels into a facility. So there's this, there's a basic tax credit of if the project is less than 1 megawatt, the investment tax credit automatically allows you to qualify for up to 30% of that cost. And then for projects greater than 1 megawatt, it starts at 6. But if we go to the next slide, there's a lot of additional percentages that we can utilize. So if you meet certain criteria, so for example, right, if we install those energy credits and you're entitled to that initial 30%, but it's also sitting in, say, a low income community, then you can get an additional 10% on top of it. So they've really laid out pretty well, and just an easy formula to kind of identify, okay, we're not only going to give you money back for your investment and your due diligence to kind of install these solar panels, but we're also going to add on some additional aspects that would support, the local economy around you. So again, these are just kind of the initial building blocks to determine what sort of credits and how much. But that should hopefully just give you a summary as to some of the credits available and just providing awareness for that. So I'll turn it over to Tony.
All right, thank you, Paul. So we are going to end today's webinar with a non-tax topic, but a very significant reporting requirement is coming in 2024 that is going to impact tens of millions of companies just in 2024 alone as a result of something called the Corporate Transparency Act, or the CTA. So the CTA was again enacted, I mentioned it kind of earlier on, it was enacted back in January of 2021, but the reporting doesn't actually begin until January of 2024, which is why we are talking about it today. And really, the goal of the CTA is to help the US detect and prevent money laundering and other types of financial crimes from occurring within the United States. And how they intend to do that is by requiring entities to disclose their beneficial owners. So to disclose basically the individuals who sit at the top of the ownership structure, having that be the requirement for that disclosure there. So I do want to point out that this is, the idea of disclosing ultimate owners or beneficial owners is not a new concept internationally. Many countries already have a similar requirement to do this, and some of them even make this information public. The CTA itself will not be public. It will only be, or the database will only be accessible by government agencies and law enforcement agencies as well. So moving on to the second from last bullet point on there, this is not an annual filing requirement. I do want to point this out because this is a pretty significant item here. You do not have to file this annually, but you are required to file an updated report if any changes to the information that you report, which we'll talk about what that information is. If you have any changes to that, you are required to file an updated report within 30 days. All right, so the next slide, who is actually required to report? What's a reporting entity? And there's two types. You've got a domestic entity, which is any corporation, any limited liability company, any limited partnership. It's really any entity that's created by filing some type of formation document with the Secretary of State, or in similar type organizations in other states. So the second category there is a foreign entity, which is any foreign entity that's registered to do business in the US by filing some type of document with the Secretary of State. So the key here is the filing of documents with the Secretary of State or similar type state agency, which you do for almost every type of entity that gets organized. So there are 23 specific entities that are exempt from reporting. And we're not going to talk about them all, but the first one on there, the large operating company, is going to be one that we think is going to be pretty significant in terms of eliminating companies that are required to report. But in order to qualify under this exception, you have to meet all three of these tests. You have to have more than 20 full-time employees in the US. You have to have more than $5 million in revenue on a prior year US tax return. And you have to have some type of physical operating presence in the United States. If you don't meet one of these tests, you have to file. Now, the second item on there, or the second exception on there, is inactive companies. Now, FinCEN has a 6-part test to go through to determine whether or not your company meets the definition of being inactive. So you can't just assume that, let's say you form some LLCs and you haven't really done anything with them yet. You can't just assume that they would fall under this exception. You do have to walk through the test. And the other items on there, tax exempt entities, governmental authorities, there's about 15 or more not listed on there. But the reason why they are not included is because most of those require some type of disclosure already in the United States with some regulatory body. So if we go on to the next slide, we talked about who reports, meaning a reporting entity, but what are we actually reporting? And there's 2 items a company that's required to report has to report in this ownership form. So number 1, you have a beneficial owner. And a beneficial owner can meet one of 2 definitions. Number 1, it's someone that ultimately owns or controls at least 25% or more of the interest of the company. Or, and we'll talk about the second bullet point on here in the next couple slides, it's someone who exercises substantial control at the company. Now, the second item you're required to disclose are company applicants, and that is really the individual or individuals who are responsible for helping with filing the formation documents. So if you think about it, if you use a law firm, that could be an attorney, it could be a paralegal, it could be both in many cases. So the one thing I want to point out is that for 2024, for entities created prior to 2024, you are not required to disclose the company applicant on the form. And the reason being that, some of these companies could have been formed 50, 60 years ago. No one is going to remember who helped file those formation documents going that far back. So the company applicant is only something required for 2024 entities and going forward. So if we actually skip over the next slide and we go to substantial control. So we talked about there's two different types of beneficial owners. One is very intuitive, right? Someone that owns more than 25% of the company, someone with ownership interest. But the second type is someone who has substantial control. And that first bullet point on there is key. You do not have to have any type of ownership interest to have substantial control and to have to be reported on this form. So it can be a senior officer, and you can look at those titles here, or anyone that performs any type of similar function. It can be anyone who has the ability to appoint or remove a senior officer, and just really some catch-alls in those last two bullet points. Anyone who exercises substantial influence over important decisions, and then anyone else who has any other form of substantial control at the company. So just keep that in mind when we're talking about beneficial owners. We don't necessarily mean someone that has ownership within the company. It could be someone that exercises substantial control. All right, so the next slide on there, we're not going to go into this too much, but so we talked about what companies are required to report. We talked about what they have to report, meaning beneficial owners and company applicants. And this is just the information that they're required to report on each beneficial owner, each company applicant. As you can see here, it is basic information. So once you determine who has to be reported on these documents, the information that you have to report is pretty straightforward here. All right, so if we go on to our last slide, some additional items here, key dates. So entities created before January 1, 2024. So all of our entities that are in existence right now, unless you mean an exception, you have to file an initial report by the end of 2024. Entities created during 2024 have 90 days, and they just changed this, to file their initial report. So this is not something you can wait until the end of the year. Again, this has nothing to do with tax filings. So this is something you have to keep track of. If you form an entity, you have to remember to file this initial report. And then going in 2025 and going forward, you only have 30 days to file that initial report once you form the company. And I mentioned in one of the first slides that if you make any changes to the information, because this is not an annual filing requirement, if you make any changes to that information, you have to file an updated report within 30 days. And if you don't, you can see we list out some of the potential penalties here, but they can be significant, including up to $500 per day that the infraction occurs, and criminal penalties as well. So to kind of wrap up this section, this is a very significant change in terms of a new type of disclosure, a non-tax related disclosure that is coming and going to impact a lot of companies in the United States next year. FinCEN, I think they estimated over 30 million of these reports, that's 30 million, to be filed within 2024 alone. So there's a lot of complexities to kind of sort out with those due dates and who actually is required to report. So again, please reach out to your Raymond advisor to kind of make sure you are staying compliant with this new reporting requirement. All right, so with that, looks like we are out of time here. A lot of stuff to consider, again, especially those prior tax law changes that we are now either implementing and they're having an impact on us right now, or that we'll be having to deal with sometime over the next couple of years. And I just want to point out, as I do on the end of all these, that really effective year-end planning or tax planning is not something you just do in December. There's so much changing, even in years like 2023, where we didn't have a lot of new legislation. We just had a lot of stuff that was coming that's been building up. So in order to do tax planning correctly, this is something that's got to be talked about, and at least it's a year-round issue there. So again, we're out of time. I want to thank everyone for joining us today. We hope that you were able to take away at least a few items from our speakers. If you have any questions, I know we didn't have any time to get any today. Feel free to reach out directly to one of us. Our email should be at the top here, or just reach out to your Raymond advisor directly. So thanks again, everyone, and have a good rest of the day.